Thank you. We've had another challenging year for sure this year, and we are now looking at a point in time when dairy producers are feeling a significant amount of stress. But it could have been worse, and that sounds a little bit trite to say, but we've had a strong domestic economy, and I thought I'd lead off with that because this has been a really important part of what we want to consider and look at. The 2009 debacle that we had in dairy prices was really largely because of the recession that we were experiencing at the time. There was a global recession. Dairy products didn't get sold to people out overseas. The products stayed at home, and they stayed at home into a poor economy. We've had some of that same kind of thing happening this year, except that our domestic economy has been strong, and it has helped us consume a lot of the dairy products that were here. So our prices were low, but not as low perhaps as they might have been. I'm worried a little bit by some of the signs that I see about a general economy. I'm showing a couple of different measurements here that have presaged some of our past turns in the general economy. One of these, the blue line, is a ratio of household wealth to income. That is your asset values, which can be land, building, stock portfolios, that type of thing, in comparison to the incomes that we're seeing. Whenever the wealth gets considerably larger than income, we often have seen that it presages the sort of recession that we've seen in the past. The other measure is a difference between a 10-year Treasury bond rate minus a 2-year rate. And we expect that the long-term interest rate should be considerably higher, that we have optimism about the future, and that in fact our short-term rates are rather a bit lower. When they start to converge and pull together, and sometimes even have an inversion of that with a higher short-term rate than long-term rate, that's a time when we are generally seeing an economy tipping into a different portion of the business cycle. You'll note here that our two previous recessions that are being shown by those gray vertical bars were times when these two measures had dipped rather strongly, and right now we are in a time period when these measures are at very low levels and are forecast in some cases, like the household wealth to income, to be trending upward, indicating that perhaps we're ready to turn the corner on our economy. We can also see that in measures like the Consumer Confidence Interval survey that's done monthly. We ask two sets of questions of consumers. How do you feel about the economy today? What do you think the economy may be like 6 months from now? The blue line is showing you the present time period, and the green line showing you the expectations of the future. The red line is just a simple average of these two things. You'll note here that before we plunged into that 2009 recession, that our present situation was great. People were basically saying, my 401k has never been better, household values are high, exactly what I was just talking about. And then we saw that people were concerned about the future. As you become concerned about the future, you maybe get conservative with what you're willing to spend. And as you are conservative about what you're willing to spend, maybe not go out to eat as often, this pulls us down into recession. After that point in time, we have had a tremendous pull back up. And you'll see that our present situation is strong and looking stronger all the time, and yet it's divergent from our expectations about the future. So this is another one of those indications, and I also would draw your attention to the far right-hand side of this graph where the green line, our expectations about the future, has taken a strong downturn here in the last survey or two. Again, indicative that maybe consumers are beginning to feel like something's beginning to happen here. Now, this is particularly bad for economies that have a largely consumption-based form of GDP. And the U.S. is certainly one of those. 71% of our gross domestic product is generated from our consumption in this country. This is very different from a country like China, where only 34% is generated from consumption. That kind of consumption is relatively low because investment is a big portion of gross domestic product there. Consumption as a basis for GDP is not either good or bad, right or wrong, but it does have some consequences. When we stop spending money or slow down, that can tend to pull us down into this recession. So I'm worried a little bit about that, and I worry about it for dairy purposes. This chart's a little busy. It's got two things on here. On the left-hand side, I'm showing our exports as a percent of milk production, and that's shown in the blue line there. Trending upward generally, but there have been dips in that, and you'll notice the 2009 dip where those products did not leave shore as much as we had expected. They stayed at home. We've had also, during our current downturn in the economy, a similar size of downturn, but trending back upward again. On the right-hand side, I'm showing you the U.S. all milk price. And while there's a lot of up and down there, let me just draw your attention to the time periods when we've had major downturn in prices. Those all correspond to time periods when our exports have been off. And that's no surprise for us right now. Exports have been off, those products have been staying here at home, and they've been pushing down on our prices, but not as badly as they did in 2009 because our economy is stronger. When those products stay home, they get manufactured into storable dairy products, and cheese is one of those. You'll note that from 2015 on through our present time period, stocks of cheese have been increasing, and notably in the red line this year, we would normally be seeing stocks pulled down at this time of the year as we go from Thanksgiving through Super Bowl, our big demand season of the year for cheese. And we've actually had stocks growing during this time period, an indication that we've just had more milk and dairy products than have been demanded. Our milk prices have been range bound. During this time period, we've been seeing milk prices a little up, a little down some years, 2017 better, but you know, they've been in that $16 to $18 range for a U.S. all milk price. We've had some plunges that have taken us down toward 16, but we can't seem to break out of that. And I don't think we can really declare our dairy problems over until we get into the $20 to $22 range for milk prices. Why has the trough persisted? Well, we collect information from farms across the state, and every year we notice that there's about a $10 range in the cost of producing milk, the cash cost of producing milk. That's a tremendous range out there. That tells us that at these relatively low prices, some of our farms have cash flowed right through this. It hasn't been as great a time period, but they haven't had to borrow any additional money either. Maybe 30% have had to borrow some more, 30% have had to restructure loans to make their cash work on the farm, and maybe 20% of our farms, rough figures here, are actually in real trouble. How bad is it? Well, Paul alluded to some of this, but this is the farm attrition rate here in Wisconsin, the dairy farm attrition rate. You can see in 2015 and 16 a much more normal loss of dairy farms of 3.5% to 4%. And beginning in 2017, that began to rise, and right on through 2018 to where now we are above 7.5% loss of dairy farms year over year. This is a near doubling of the rate of dairy farm loss, and it's one of the reasons we're going to talk about consolidation this afternoon. Why have we had the long trough? Well, it's not because of milk production exclusively here in the United States. It's milk production with our competitors for sales of overseas products, export countries. This is a bit of a busy graph, but the dark blue line there is showing you the change in milk production in the European Union. They've been up and down quite a bit. This last year they had severe drought, and they are now also being hobbled really by the same low milk prices that we are. Our milk production in red has been a bit more circumspect through the whole time period, and in fact we're less than 0.5% increase in milk production growth at this point in time. The green line is showing you New Zealand. This is a country that has a trend for increased production, but they're also much more impacted by production risk rather than price risk. So if they have adequate rains and not too much, then pastures are good, milk production is strong. That's where they've been this year. Record production for them. In the U.S., cow numbers have finally begun to decline, shown in the red line here. They were increasing prior to that, and of course that's half of our equation for total milk production is the number of cows. So as cows come down, we are seeing a contraction in the growth of milk production, but not the total growth in milk production. The other part of that equation is milk per cow, a very strong trend line for increasing production year over year, and we haven't yet overcome the milk production per cow with few cow numbers. So the percent change in milk production in the U.S. tends to be between 1 and 2%. You'll note that back in 2016, late 2016, early 2017, we were well above the 2% range, and that's been trending downward, so we're still in positive growth territory, but now, as I mentioned, about 0.5% growth right now since our last milk production report. Dairy products have been a good buy. This is the Bureau of Labor Statistics index for all dairy products. They peaked for consumers at retail in 2014 and have been declining ever since. They're lower in 2018 than they were even in 2012 and 13. So dairy products have been a good buy for consumers, and we have had relatively strong demand. But it's not a strong demand for all segments of the dairy industry. Fluid milk sales have been in almost free fall, a real decline out here. You'll note that at 2010 we began to have a tremendous downturn, and we see this month over month now, the drop in fluid sales. So fluid milk sales have been a category of consumption where dairy has not kept pace. But it's not all bad news either. If we take a look at cheese consumption, this is on a per capita basis. Back in the 1970s, it was about 13 pounds of cheese per person that we consumed. Last year, it was over 37 pounds of cheese per person. So we are doing our bit, and I would encourage you to have a cheese platter for the Super Bowl. We need it. By the way, I don't think that this is a trend that's out of steam. There have been some folks that have begun to worry about this, but when you take a look at a few other countries that we might consider our peers, countries like Germany or France, their consumption is above 50 pounds per capita, so we perhaps do have some room for continued growth. Is there a little bit of room for optimism? There's a bi-weekly auction of dairy products that takes place, sponsored by Fonterra out of New Zealand, and this dairy trade index is a kind of unique auction where the auction is rerun until the known quantity of product that's brought to that auction is just exhausted. It gives us a good indication of the relative value of dairy products on world markets. This has been flat and declining even in 2018 until fairly recently in 2019. The last 4 trading sessions, we've seen an uptick. And I put a question mark there, some optimism, because as you can see, looking back just before 2018, we had a downtick and then a little uptick again. And we saw the same thing in 2017. So we have had time periods where 3 or 4 consecutive auctions doesn't necessarily tell you what the bigger trend is going to be. However, I'm actually thinking that we have some room for optimism and that this uptick is only the beginning of something just a little bit stronger. One of the charts that I'd like to show that's been making it difficult for milk prices to fully rebound has been the world stocks of some dairy products, including skim milk powder. The European Union has a program that's very similar to our old dairy price support program, where they would buy product off the marketplace, hold it in storage, and make it available later and for sale when prices recovered. There was a big accumulation through 2015 and 16 of those stocks to well over 350,000 tons of product. And that has made it difficult for these prices to begin to rebound. But you'll notice that they have been working those products out of storage pretty dramatically lately, and the EU is convinced that they will be out of stocks before they get through halfway through 2019. It could be the case, it may take a little longer, but I'm quite sure that it is going to be in 2019 that those stocks go back to zero again where they would otherwise normally be. Despite the trade tensions that we've had that have been much in the headlines, we've got room for growth. China has a per capita consumption of dairy product that's small. It's only about 23 pounds of milk equivalent per person compared to a world average of about 111 pounds. U.S. average is 640 pounds. There's room for growth there. China's small dairies have also been exiting the industry at a faster rate than their mid-size and large dairies have been growing. So their milk production has actually shrunk. Now, they've had historic purchases of quite a bit of U.S. dairy product, especially whey. They are the world's largest purchaser of whey, and we are the world's largest producer of whey. So at some point in time, we are going to have to begin talking again about those sales, but we do have stubborn leaders in both countries. We've recently concluded, but not fully yet, it's been signed by our leaders, but not passed yet by our Congress and other legislations. But the U.S.-Mexico-Canadian agreement has been signed, which provides some improved access to dairy markets in Canada for the United States. This is a small positive. I warn us against getting too enthusiastic about it, but it is a positive, and it will come a little bit later over the time period. So it's something we can look forward to. As far as our trade with Mexico, our largest trading partner, it kind of takes us back to where we were, as long as we can begin to get past our steel and aluminum tariffs, because Mexico still has retaliatory tariffs on cheese as a result of those. But Mexico has started to purchase product again. These three charts were taken from U.S. Dairy Export Council, and it's showing our major destinations for export in the last month we have data for, which was October. You'll note that Mexico in the top graph is showing you the skim milk powder exports. Mexico picked up the pace quite a bit there, as did Southeast Asia, by the way. Cheese exports, oddly, even though those tariffs are still in place, Mexico picked up the pace with cheese purchases in October. I can hardly call that a trend with only a month or two's worth of data, but it, I think, bodes well. In the bottom graphic, I am showing you whey exports, and you'll note that China, our largest customer for whey, is half of where they were before. There have been some other factors out here. It's not just trade retaliation, but it has had an impact. As soon as trade retaliations were announced, our markets jumped on that with a downturn that in a matter of days or weeks became something like $1.50 to $2 off of futures markets for Class 3 and 4 dairy products. Our trade models actually suggested that those should be much less than that, that trade would be renegotiated as we found new customers that we hadn't traded with before, and they in turn found sales partners that we had previously supplied. It might have been more like 50 to 75 cents, but that's not what actually happened. The trade mitigation out there meant that the markets picked up that tone of negative futures markets, and that made its way into milk prices. The trade mitigation payments that Paul was talking about that have been relatively good for soybean producers have been really almost negligible as far as dairy is concerned. It's a very small payment. But our MPP program in this last year that was changed will have paid about 62 cents a hundredweight on the first 5 million pounds of historic milk production at the $8 level to dairy producers across the country. This is a significant payment and certainly a help. There were a lot of farms that did sign up for that level of coverage last year. And there is some enthusiasm for this new product, the revenue protection product. We see nationally that there are about 11 billion pounds of milk that are under endorsements right now. But that product is a product that relies on futures markets, and they can only undergird the kind of optimism that futures markets expect. As Paul did mention, our dairy margin coverage program, the new version under the Farm Bill, which will be implemented sometime this year, I think looks very promising, especially for smaller dairy farms. So here are my price forecasts. The dashed lines are showing you the price forecast that I have for Class 3 in blue, Class 4 in red, and the U.S. all milk price in green. You'll note that I have an upward trend here on all of those. It's unusual, but by no means unheard of, to have this sort of inversion, I guess, in prices where Class 4 is actually a stronger milk price than Class 3, but I'm projecting that through the rest of the year. Milk proteins have found new footing and new ground. And the fact that our all milk price isn't higher reflects the fact that premiums have eroded in many parts of the country, including here at home. So as far as contributing factors go, there's some things that I think are positive and pushing us toward stronger prices. Those include a slowing U.S. and world milk production. There are declining world stocks of dairy products. We've had a relatively strong economy as well, and that's been a good thing. And we have finally settled some of our trade negotiations. So trade improvements, I think, are positive factors. And we have an El Nino that is forming in the Pacific that generally brings drier and warmer weather to this part of the country. Doesn't appear apparent today, but nevertheless, it's also more important, probably not for this country, but what happens on the other side of the Pacific. Australia has been just pounded with heat and drought. Their milk production has suffered as a result of that, and we may see that the El Nino begins to impact production in New Zealand as well. We don't wish bad on our neighbors, but tightening up some milk supply wouldn't hurt the world prices at all. On the negative side, New Zealand's production has started out strong, so they've been putting a lot of product on world markets. We've had slow gross domestic product growth in some countries like China. Their growth is still enviable in consideration of what our GDP typically is, but it's a slowdown for sure for China. We've had prolonged trade negotiations with some countries. Again, China is notable there. And I say here, as I started out, there's a possibility of U.S. recession. That won't be good for domestic consumption of dairy products. So my forecast is this. Unless circumstances change significantly on the export side, I can't be overly optimistic about prices in 2019, but I think it's easy to be optimistic. I don't think that our milk prices are going to feel good until our exports on some kind of 12-month rolling basis would be about 17 to 18% of milk production. We're getting there, but we aren't there yet. At that point in time, I think we have room for our futures markets to begin to be more optimistic about prices. I'm forecasting the 2019 Class 3 price to be up by only about 80 cents. Class 4 milk price is up by considerably more than that, $2.15, and the all milk price up by about $1.10, and that reflects the weak premiums that I spoke about. Basically, 2019 is going to feel better than last year, but not quite as good as we had in 2017. We'll still be range bound. We're losing more farms in this state and in the few other states where we have monthly dairy farm numbers available, but we aren't losing our capacity to produce milk. It's slowing, but it certainly isn't negative just yet. And, with that, I guess I pose a question that we can discuss in the afternoon. Is this the new normal? In other words, are these milk prices we're going to have to learn to live with? Or do we have the opportunity to say we'll grow out of these and this is a little bit below that normal level? But with that, I would close.